Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. With the official cash rate rising to a 10-year high of 3.1% this week, there are plenty of questions of what this means for the property market. How did the spring selling season this year compare to previous years, and did the run of successive rate rises take the heat out of the market? Eliza Owen is Head of Research at CoreLogic. Eliza, welcome back to Fear and Greed.
Thanks for having me.
I love the spring selling season, Eliza. It's a time to get very excited. Was it the busiest time this time around? How did it go?
2022 was really different to what we've seen previously. Usually you get these longer daylight hours and really good weather and gardens looking their best, drawing out more buyers and sellers of real estate. But for 2022, we didn't just see a lackluster spring selling season. We actually saw less new advertised properties coming to the market than we saw during the winter of 2022. Wow. And that's the first time that that's happened in at least 12 years.
Why? So let's actually, before we go why, I'm just interested. So people, anytime I've visited an open house, the place always looks great. I'm just interested, do they get more money? Do you get more money for your house if your gardens look good?
Look, there's not actually too much seasonality in price movements, and that's because both supply and demand fluctuate and have that seasonality. So even though you've got more buyers out there, you've also usually got more choice and more property in the market, which tends to iron out some of that seasonality in price.
Okay, so let's go back to the why. Why were there more houses on the market in winter than spring?
So I think there's a couple of reasons for this. For springtime in 2022, we probably really saw that rising interest rate environment starting to take hold on prospective new buyers. So I'd say people were probably dissuaded from buying amid a higher cost of debt. And even those who were still confident about buying this spring would have potentially been able to borrow less. So sellers, knowing that they're not going to get as good a price for their property as they could 6 or 12 months ago, have probably held back and are waiting for a better time to sell. I think another potential reason is just that transaction activity was so strong in 2021 that this low interest rate environment we saw in spring last year maybe brought forward some buying and selling decisions as well.
Okay, so we saw irrationality in 2021, but what you've just described, it sounds a lot more rational.
Yeah, I think that it's just a response to interest rates. I don't even know that the 2021 buying and selling frenzy was necessarily irrational, because with that record low interest rate of 0.01%, actual interest costs would have been so low. And you would have had a lot of household savings built up through the pandemic as well, because people weren't spending on services, going out, traveling, all contributed to that strong buying activity.
Eliza Owen from CoreLogic, I'm never going to say 2021 was irrational again, because you've just shown why it wasn't. There are the 2,700 homes scheduled for auction this week, and that's the fifth week in a row where there's been an increase in the number for auction. Busiest auction week since May. Why do you think? Are things getting back to normal, or is it just sort of to get in before Christmas?
Yeah, so I'm glad you brought this up, because it really feeds into that piece we were talking about with spring selling season as well. Auction volumes, while we typically think of spring ending in November, the auction market does tend to peak a little bit later. So that's what we're seeing here. This is a little bit of a seasonal uplift that we usually see a peak early to mid-December, noting that last year there were nearly 5,000 properties scheduled for auction. So when you think of it that way, the 2,700 odd properties that are scheduled is a bit dull in comparison.
Stay with me, Eliza. We'll be back in a minute. My guest today is Eliza Owen, Head of Research at CoreLogic. Okay, now on your numbers, obviously house prices have come off. Sydney, I think, is 11% or more from peak to trough, and still going probably. I think nationally, capital cities was closer to 7%. Correct me if I'm wrong there. What do you think the story is, I mean, at least last month, the pace of decrease slowed, if you know what I mean. So we weren't falling as fast type thing. Do you think that will continue? I mean, what's your feel for where we're going?
I agree that there's been a pretty consistent slowdown in the rate of decline. So monthly declines for Australian housing values bottomed out at 1.6% through August. And since then, it's gotten smaller and smaller to a 1% decline in November. But here's the thing. I think there is a little bit of a risk of that monthly decline re-accelerating in 2023. And some of those risks include some pretty clear signalling that there are going to be further rate rises early next year. The RBA ending their December monetary policy statement with, "We expect further rate rises in the period ahead." And on top of that, you've also got this fixed term cliff that's coming off. So the market might be tested by people rolling off home loan rates as low as 1.95% into a variable rate environment where rates are 5 to 6%. So that might see slightly more motivated selling, higher listings volumes, and further downward pressure on property values.
Okay. When we look across the capital cities, so Sydney has fared worse, but it did very well in the run-up. There are other cities, again, you're going to have to correct me because I'm sure I'm going to get them wrong, but Adelaide, Perth, I think Brisbane is in this crowd. They just haven't fallen by as much. Will they, keep falling basically while Sydney and Melbourne stabilise? Or is it just a Sydney thing, a Melbourne thing? How should we think about it?
Your stats recall is pretty excellent, I have to say. So it is a peak to trough in Sydney of 11.5%, and this ranges to declines of less than 1% for a city like Perth, for example. I would say the main characteristic of markets that are having steeper price declines are that they're more expensive. So Sydney and Melbourne have had more volatility throughout the past few cycles, including the one we're in now. So you would expect steeper declines. Perth and Adelaide and Darwin, which are our highly affordable markets, have seen around peak to troughs of 1% or less so far. Brisbane, a little bit different. It's not quite as expensive as Sydney and Melbourne, for example, but it has risen a lot in value. And I think affordability constraints are really setting in for buyers. Maybe people have needed to extend themselves a bit more to buy into the Brisbane market. And it has actually seen a relatively sharp downswing, noting that values across Brisbane are still almost 30% above their pre-pandemic levels, but they're down about 8% from a recent peak.
Okay. What about the regions? And I'm sure location. It depends where in the regions we're talking about, but some of those more popular regions, sort of south of Melbourne, Gold Coast, north of northern New South Wales, those sorts of popular areas, how are they going?
Yeah, you're quite right. So regional Australia in aggregate has had less of a downturn than the combined capital cities. As a whole, regional Australia is down about 6% from a peak in June, compared to the 7.5% decline across the capitals. But your higher end, more expensive regional centres that are sort of almost more like their own cities have seen big run-ups in prices, but a lot more volatility introduced through the downswing too. So the Illawarra region is probably a good example where we've seen a massive run-up in prices, upwards of 40% from trough to peak, but now prices are down 11.5% from their peak, which is the same peak to trough we've seen in Sydney so far. So I think that's very telling about how some of the structural changes that we saw through COVID, maybe higher incomes being introduced to these popular regional centres, has also introduced more volatility in their cycles.
Okay, so crystal ball time here, Eliza. What's going to happen? What's going to happen in 2023? Will investors come back into the market with a bang? Do you think we'll see a shift from auctions to private treaties? But mostly, what do you think is going to happen to prices? So there's about 3 questions there. I've given them all at once. Let's start at the beginning. Investors, are they in the market? Will they come back into the market? What do you think?
It wouldn't surprise me to see some investor activity come back, but Investors tend to shy away when things are uncertain. So we'd need to wait for some kind of stability in the cash rate environment for investors to be confident, I believe. But everyone knows the rental story at the moment, where even as prices fall, rental incomes are rising, rent values are up 10% in the year to November, one of our near record high growth rates that we've seen through the cycle. And the other thing too is that this is a potential strategy as people roll off of fixed term rates as well. You might see people renting out a room or converting an owner occupied property to an investment property if they can find somewhere cheap enough to live. I think that adoption of a rental strategy is something that might actually help people with higher serviceability costs in the year ahead. And hopefully that adds a bit more supply and eases some rental pressures.
Okay, what about the auctions versus private treaties? Do you think there will be any much change in that?
My understanding is that historically auctions are used in a hot market, right, to drum up excitement about a property. In a cooling market, auctions can give the game away a bit too much, that there is a bit of a softer demand environment. So I would expect more private treaty, similar to what we've seen this year, not as many auctions going ahead.
Okay. The $64,000 question, the one we all want to know, what's going to happen to house prices?
I think in the first half of 2023, I would expect them to keep going down. And again, this is just in line with some of the expectations for the cash rate, which is the biggest short-term determinant in house price movements. But there are some tailwinds to look forward to. The return of overseas migration, which has really started with a bang in 2022 and will continue filtering through to more housing demand in 2023. We've got a pretty strong labour market, even as the RBA is trying to unwind it a little bit. That's helping to underpin serviceability and will keep a floor under housing market declines as well. But as I mentioned, the major headwind to that will be the fixed term cliff and what that does to the market. There are also going to be some supply shocks to watch out for that could change the inflation and interest rate trajectory. So for Australia, that could mean bushfire season and extreme weather events. Internationally, it's going to be things like energy prices, global conflict, overseas growth and demand. So, you never know exactly what is going to happen, but I'd say Australia's housing market will be guided by cash rate movements in the short term.
Eliza, thank you for talking to Fear and Greed.
Thanks again for having me. Take care.
That was Eliza Owen, Head of Research at CoreLogic. This is a Fear and Greed Daily interview. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.